Hello everyone and welcome to this edition of Startup Central. I'm Avanne Dubash. Well, let's take it straight then to our top story of the day as we talk about the dizzying valuations as we do a bit of a reckoning for the year gone by. For instance, we've seen the likes of SoftBank slashing the value of its stake in Oyo Hotels. You also had Farmeezy's fundraise that was at a 50% valuation cut. And in the public markets as well, some of the big technology companies like Zomato, Paytm, Nykaa, etc. have seen investors really burn their fingers with massive losses a year into their listing. So let's understand a little bit more about the outlook for the IPO market in the year 2023. Have any lessons been learned and what do investors need to really focus on? Siddarth Pai is the founding partner of 341 Capital. He joins in on the show along with Radhika Gupta, MD and CEO at Edelweiss Mutual Fund. Good to have you both on board. Radhika, I'm going to begin with you. You had that quote actually saying that the IPO market, on a tweet rather, is going to be one of the most interesting ones to watch. Are we going to learn any tough lessons from 21-22 or continue to dance with the devil? And I think the question stems from the fact that, how do companies like this even manage to get these kind of valuations?
I think that there's been a lot of furor in the last few weeks, especially with a couple of new DRHP filings. Whenever this happens, people say, how do they manage to get? Well, I think promoters will quote whatever valuations they have to in the market. And India is an open market, so people often point to the regulator and say, how is this possible? I think that will be possible all the time. I think what needs to happen is that we as investors need to exercise a lot more diligence and ask a lot more questions of the companies that are coming to market, both as asset management institutions and as individual investors. So I think 2021 was a very, very heady period. There were very new business models that were coming to market. We were in a virtually zero interest rate regime, and growth does well, not just in India. I think the story and the narrative that you've repeated is not, divorced from what has happened in other parts of the world, including the US. But the tide has obviously changed in 22 and coming into 23 with rates rising. And I think also, finally, what the equity market is looking for is a company that can manufacture a good or service and sell it in a sustainable way that makes money for customers, but also makes money for shareholders. So storytelling is important, but it has to be storytelling backed by a business model. And I think there will be a lot more scrutiny around names that come to market because people have bought their names with very, very large brands. So I think there will certainly be a lot more scrutiny, and there should be. Recall we had experienced something like this in the IPO market after 2007, when in that bull run, you had a lot of sort of fluffy IPOs that came to market. And I think people were a lot more diligent about infrastructure companies, etc., that came to market. They were a lot more diligent about governance. So now I think with new age companies, people will definitely peel the onion, and they should.
So let's get in your take. While, you have a lot of these companies, as Radhika said, quoting any valuations that they like, why would VC and PE investors accept these numbers and, accept these sky-high valuations, if we were to just understand that?
Sure, I think that's actually a fantastic question. I think this borrowing a leaf from what Radhika actually said right about now is a lot of these investments were actually made in an era where interest rates were actually historically low. Because interest rates were low, and if you actually look at the discounted cash flow model itself, there's virtually no difference between the cash flows arising as of now versus cash flows coming 3, 4, 5 years down the line itself. So growth actually was placed a massive premium. And most of these companies also end up actually going 3, 4x within various rounds of funding itself. So these are the parameters that people actually end up looking at. Now, given the fact that interest rates have actually started rising and growth alone is no longer the sole determinant of success. It's actually now growth led with actually free cash flows and ability to actually turn profitable over time. The quality of the growth becomes far more important. So VCs have also actually changed their playbook as of now. We've seen in 2022, the VC investments, the number of VC funds raising cash was actually far higher than the number of deals that were actually done in the open market itself. So everyone's actually loaded up on dry powder right about now. VCs also have a much longer duration horizon because we're in the private market. We don't have a liquid market that can actually go and exit these particular stocks in case you don't like it. Any of the bets that we end up taking are usually there for a 3 to 5 year horizon itself. Once you take those particular views, the investors who've actually gotten into Mamaearth at the point of inception, even 5 years ago for that matter, they've actually seen the value actually compound very, very steadily. And the growth and expectation of the market is that the company should be able to deliver on these particular parameters as they end up going forward. If we contrast even the IPO of Mamaearth as of now versus Zomato. When Zomato came in, there was actually zero profitability, so the PE didn't actually exist. Now that these guys just actually have incipient profitability, the PE actually looks very, very rich. But if you actually compound that PE with the growth that you end up seeing in the particular EPS over time, it does actually end up subduing that a lot more in that regard. PE by itself can't actually looked at in isolation. You need to actually look at the other fundamental parameters of the business before anyone actually comes up to a conclusion. And ultimately, as you know, the market's the ultimate decider of this. There have been several great companies with strong fundamentals that actually suffer in the market because of perception. There are other companies with not so strong fundamentals that actually end up flying. I think there is no logic that's inherent to the market. All of us are beholden to the market and the decisions that it makes, and we can only do best to actually navigate these particular complicated channels to the best of our abilities.
You know, you bring up a good point, Siddarth, about looking at all fundamental parameters and not just the valuations. But Radhika, it seems perhaps for a lot of investors who put their money into the IPOs last year, maybe too little too late, because they had that rude awakening after the companies made their debut on the stock markets, and then we saw the losses, or, you know, the companies really face a lot of flack. What do retail investors need to do in order to avoid this from happening?
You know, firstly, and we run perhaps the country's only retail IPO focused mutual fund, and our historical experience is that retail investors have rarely gotten IPOs right. If you look at today's DRHP of an average IPO, it's 300 to 500 pages. To expect a retail investor to go through all those disclaimers and truly get it right in all risk factors is a hard ask. What we often see, and we have data to back this up, is that retail investors think of IPO as a be-all and end-all in a company's life. When IPO is just a point, it's just a point of coming to markets. There are some IPOs, by the way, that have disastrous listings and go on to become phenomenal. I quoted Page Industries as a classic example of this. And there are some companies that IPO when they're just not ready to IPO. So I think retail investors shouldn't look at IPOs as a short-term opportunity. It's just an event in the life of the company. And good companies, regardless of factors like gray market premium, social media noise, all this stuff, influencers will find their life, will get analyst attention, will get rated upwards, and will deliver over a 3 to 5 year period. I think the other thing for retail investors that's been tricky, Avanne, is that a lot of the IPOs coming, particularly in the new age space, are brands that retail investors love and that they're familiar with. But just because something is a brand that you are familiar with and is providing a great service doesn't mean it's going to have a great debut, and it doesn't mean there's a great investment case. I would just add one point on companies that are listing. I think one of the things that I heard a lot last year after the debacle of some of these IPOs is that, the business models, the market doesn't understand the business models. And my argument is that if the market doesn't understand the business models, companies shouldn't IPO. There is a life cycle of a company when you focus on revenue. There's a time when you focus on users, and there's finally a time when you have to move down the P&L statement and focus on profitability. Don't be in a rush to IPO. IPO when the business model is not only clear, but it can be explainable, because private markets and public markets are very different worlds. Business models need to be clear for retail investors. They need to be predictable. What we've seen in a lot of new age companies is the challenge is not only around losses. It's also around not doing what you said. It's around basic questions of governance. So there is also a time to IPO and a time to take your story to retail. And sometimes I feel some of them might be a little premature.
Now, Siddarth, the IPO disclosures are already fairly extensive in India. Do you think that that's where the problem lies? They need to be made more tighter, perhaps highlight some of the issues of past performance? Or is it, purely up to the retail investor putting their money into that, saying that, you've done your homework, no one's forcing you to buy into the stock, and perhaps a little more on that front?
So I don't think disclosure is actually an issue right about now. SEBI's actually done fantastic work to ensure that there's complete transparency But I think that complete transparency is actually translated to about a 300 to 500 page book. It's sort of taking people back to college where they have to cram before a final exam before they end up doing that. It becomes hard. Most people just skim through like the cliff notes of this. They actually look at what blogs say. Twitter has now become the proxy to understand what exactly happens in DRHP. I think I've lost track of the number of posts that have come out from fairly influential people saying, I've read through 400 pages, so you don't have to. They only talk about one element, not about the entire business. So these are the kind of things that ends up happening. So I don't think disclosure is actually the issue. I think what's actually important is, as Radhika said, IPOs, you take the entire history of a company and actually distill that down to a document itself. And that document does not become the sole determinant of whether a company does well or not. It doesn't actually indicate whether the management has the appetite to actually go and meet analysts, face all of them, face an entire army who keeps asking these probing kind of questions, uncomfortable questions and the like itself. I think from their side, and as Radhika also said, familiarity does not trump fundamentals. We can't actually end up having these people look at that. Look at fundamentals also. There are so many views of fundamentals that end up existing. Some people actually end up looking purely at revenue growth. Some people only concentrate on profitability. Others only look at free cash flows as a sole determinant. I think the beauty of the market is that every single point of view that you have, there is a counter view and a counterpoint that does actually have data to end up backing that itself. So as retail investors, I think for some of these more risky bets, it's actually better for them to actually go through a fund manager or to a mutual fund or something like that. Because the manager and everyone does actually put in the effort. And it's easier for you to look at a mutual fund and look at their performance, or look at a fund for that matter, look at their performance and determine whether you want to do that. Once you have stability, once analysts start covering these particular stocks, and once they have a track record, you see how the promoter behaves when it comes to the media, how the promoter behaves with analysts, how clear they are about their plans, how they actually hit their plans, then you can start taking individual bets. I think a large section of the retail investors have been spoiled by 2021, where every IPO popped when it came to the market. So people would borrow money, buy that particular share, dump the stock in 2 days, make a short-term killing. An IPO is supposed to be a longer-term story. It can't end up being a short-term thing itself. So going with that kind of view, it will actually hold you in very, very good stead.
Yeah, fair enough. And, Radhika, do you think when it came to the Mamaearth valuation, so many news reports, so many Twitter posts, and, so much said about it, did people really jump the gun there now that the clarification is out from the founders? What's your opinion?
It's hard to comment on a single issue, but as Siddarth said, I think we are in an increasingly social media and influencer sort of led world where everyone comes out and makes a statement. Now, the challenge with some of the new age companies is founders, CEOs, and I'm not talking about this particular one in general only, they're out there, they're visible. And, when you are visible, when you are out there, when you're almost a public figure, there are challenges that come on the other side. So, an unknown infrastructure company or an unknown logistics company files a DRHP, chances are it's not going to make as much noise as something like this because the company is known, the promoters are known. There's so much noise. In some sense, they've used social media and they've used these channels to grow. So you also see the backlash of it. And, is that going to stop? I don't think that's going to stop. People are entitled to their opinions. And history has not been kind. So I think people are entitled to their opinions, and some of them have used the social media route to grow. So it has a side that's backlash. I just wanted to point out something that, Siddarth alluded to. For many, many investors, I often think, and he said it, I didn't, the fund route turns out to be a much better way to look at this category. To give you an example, I think since we've been running an IPO-focused mutual fund, we've seen 200 IPOs in the last 5 years. We would have avoided 150 or 160 of them. And that is the amount of diligence that I believe IPO investing needs. Just because a DRHP is filed, just because a company lists, and just because there's noise, doesn't mean you have to go out and do it.
An interesting point, and I just want to drag that question forward, or that comment really that Radhika made, that the challenge is that a lot of these new age founders are made public figures. Siddarth, how do you look at this as a pro and as a con? And if you could, share your thoughts on Mamaearth as well?
It's a feature. I don't look at it as a pro or a con for that matter. Social media exists for everyone. You do have to put in significant amount of effort to get a following for that matter. And if there are people who play the game a lot better than others, then kudos to them. There are, like I said, even the best investors in India don't have a very active social media presence. They rarely actually do interviews for that matter, and they are very well respected. Whereas you have a bunch of others who spend more time on Twitter than they actually spend in front of the screen, actually trading for that matter, who actually have a sizable following as part of that itself. So I think in this case, even in the Mamaearth case, for example, I think the fact they've actually been on Shark Tank and everything, they sort of become a household name. They've actually had, there were some recent controversies also that have actually unfortunately affected them. But the fact that they have Shilpa Shetty as a brand ambassador and everything, they've actually played the marketing game very well. And for the D2C brand, marketing is actually important for that matter. So as an investor, what you look at is what is the return on that marketing spend actually generates. That actually becomes a key driver of efficiency of the business. If those kind of returns are not actually satisfactory to you, then it's better for you to avoid that particular stock and start looking at other stocks itself. Whereas some others may believe that particular marketing spend is justified, the returns are acceptable, they can actually end up taking that particular offer up. So see, however you slice and dice this particular offer, not just this, but every single startup offer or IPO offer that happens, you'll have equal number of people saying no, equal number of people saying yes, and the market ultimately ends up deciding these particular elements. So I think no one's actually, like I said, no one's forcing you to actually buy that particular IPO stock. If you are looking for a differentiated, you're looking for a diversified way of getting into this, there are several IPO funds that exist. Dip your toes in that rather than getting into it. No one's actually said that. Everyone looks at an IPO, says that this is the Infosys. Infosys took 30 years to reach that kind of reputation. During that time, I'm fairly certain people have lost track of the number of companies who IPO'd along with them that have actually crashed and burnt. So that IPO, you can't look at every company through that lens and say, because it's tech, it'll be the next Infosys that end up doing that. Those were a phenomenal set of individuals that have actually built an institution that few can actually end up rivaling. And that takes time. So unless if you lack patience in the market, it will actually become counterproductive for you. You will actually end up losing a lot more money. That's why I say funds are a better aspect. Look at Mamaearth the way you look at any other IPO for that matter. Don't get fooled by familiarity. Familiarity cannot trump fundamentals. So everyone has to do their homework before they actually get into that particular stock itself.
I like that. I like that. Familiarity cannot trump fundamentals. So just a quick word, both of you. Radhika, future of fintechs, future of companies listing in 2023, what's it going to be like?
Look, I mean, just because we had a few new age challenges doesn't mean that there are going to be, only poor listed companies. By the way, I think in a capital market like India and in an economy like India, the IPO market is a structural opportunity. That's one of the reasons we run a fund, because a lot of our sectors today, our market cap and our indices largely represent old economy companies, and a lot of sectors have to list. For instance, your largest exchange is still an unlisted company. So there are a lot of high quality companies, market leaders in meaningful sectors that will come to the listed market. So in no way would I write off the IPO market in general this year or structurally, and private equity and venture capital money that has gone into companies like this. Even old economy companies needs an exit. So I think opportunities will be there, but you will continue to need to be selective. On more new age companies, which tend to come under fire when we talk about IPO, I think the audience will be far more discerning. I think money managers and retail investors will be far more discerning. They will ask many more questions. And I truly think hopefully companies will be a little more discerning about what price they want to IPO at and when in their life cycle they want to IPO at. I think Sanjeev Bikhchandani once told me that a great company, and Siddarth was talking about Infosys, is truly the effort of a lifetime. And that is something to keep in mind. Building an institution is not a short-term game. And I repeat, an IPO is a point in the journey. You should do it not to give an exit, but to build a long-term institution. The other thing I think people will be a lot more diligent about is, why are you doing an IPO? Is an IPO an OFS that is going to give an exit? Is 80% of the IPO private equity and promoters giving an exit to retail investors? Or are you actually doing an IPO, to add capital to the company? There was a small IPO that happened, I won't name the company, of a financial distribution company, which didn't have a large OFS. The promoters are committed to the business. The company has done extremely well since IPO. The story was very, very clear. The business was very clear. And it happened, right after a few mega IPOs flopped. So I think people will also look at the contours of the IPO and why you're doing an IPO.
Okay, Siddarth, some closing comments from you on the future of IPOs, listings, all of that in the year ahead?
No, I think in order for a capital markets to deepen and to truly reflect the aspiration, the reality of India, we need a lot more of these companies to actually end up IPOing. But when they actually IPO, like she said, it's not the end of a journey. Maybe the end of a journey for an early stage investor, a private equity, or a VC person. But the promoters also need to take a call saying that the IPO is the beginning of an entirely new chapter. In fact, for some cases, actually an entirely different book as part of that itself. So they need to view it from that particular lens. I think what we've seen maturity. In 2021, hardly any of the companies that IPO'd, the newest companies that IPO'd actually had profits. Now we have the first company that actually has profits and they're growing. I'm fairly certain as we go down the year, a number of them will actually start increasing profits and start looking a lot more attractive in from a conventional lens itself. So I think it's an evolutionary process. We can't actually discount an 84,000 strong ecosystem on the back of about 6 or 7 IPOs. Let's actually wait until they actually reach 100, 200 for that matter and become deeper, in which case the entire conversation will change. I'm still hopeful that I'm actually proud of Mamaearth for being a pioneer to actually end up entering the IPO market in what has been a truly horrendous time period for everyone. And I'm fairly certain that people will actually build upon however the IPO goes. The learnings will actually be instrumental in the next set of IPOs we see from new age companies as they end up listing and continuing that journey.
It's been great having you both. Thanks so much for joining in. And now maybe we'll get in a discussion when Mamaearth actually lists. Good to have you both on board.
Thank you so much.
Thank you.